This is Nightly Business Report with Bill Griffith and Sue Herrera.
Let's talk Turkey. Turkey's currency plunges against the dollar, raising concerns that the country's fragile economy is on the brink of a financial crisis and sparking fears it could spread, sending the Dow down almost 200 points.
Cracks in the foundation. Two new reads on the housing market suggest there may be pain ahead for the industry.
And a whole new ballgame, how pro sports have found their next best way of making money, and it's not on game day. All that and more on Nightly Business Report for Friday, August 10th.
And we do bid you good evening, everybody, and welcome on a beautiful summer day here in New York. The word on everyone's lips today was Turkey. And not the Thanksgiving kind either. The country that straddles Europe and Asia sent shivers throughout markets around the world. Turkey's currency plunged about 20% in a single day, igniting fears of a financial crisis similar to ones we've seen in the past in Greece and Cyprus. And that sent European markets sharply lower, and our stock market then felt the heat as well. Michelle Caruso-Cabrera tells us now why the Turkish currency matters.
The leader of Turkey, Recep Erdogan, has increasingly spooked investors since he became leader of the country back in 2003. As a result, more and more foreign investors have been leaving. And when those investors leave, they don't need the Turkish currency anymore. So they sell it. Whenever you have more sellers than buyers, prices fall. That's what's been happening to the Turkish lira for months, even years. But it's gotten much worse more recently after the U.S. imposed sanctions on Turkey after the country refused to release an evangelical pastor from prison, as President Trump has demanded. The U.S. market was spooked today because President Erdogan made a very defiant speech where he seemed to not want to acknowledge things that need to happen, like a hike in interest rates. And it's led to fear of possible contagion from Turkey's economic drama, perhaps in the rest of the world. That's because Turkey and the businesses in the country owe a lot of money to overseas banks, which they'll have to pay back in dollars or euros. If Turkey can't pay those banks are going to suffer losses on those loans. How bad those losses are going to be is a key question. And could it lead to some kind of banking crisis in places outside of Turkey? Few analysts think right now that's a probability, but the possibility was enough to get investors to take a little risk out of their portfolio today. For Nightly Business Report, I'm Michelle Caruso-Cabrera.
Exacerbating the lira's drop, President Trump tweeting that he would double steel and aluminum tariffs for Turkey alone. This followed the Turkish president telling his people change their dollars, euros, and gold into lira. Kayla Tausche has more.
The tweet from President Trump sent shockwaves through the market. The president suggesting tariffs of 20% on aluminum and 50% on steel, just for Turkey, calling relations not good. The informal order coming as tensions between the two countries boiled over, causing a steep drop in Turkey's currency and a call from Turkey's president that it would prevail in what he called an economic war, hiking tariffs, which Turkey says is illegal, potentially salt in the wound.
This does create more problems, and I think that's what troubles the market so much. It's not just what's happened, it's the fact that the two leaders are not trying to work out something to dampen down the problem. They're in fact taking measures to exacerbate it.
Companies buying steel and aluminum from Turkey are now caught in the middle of the mayhem. Frank Berggren runs Metal Partners International, which processes and distributes rebar. We first spoke with him in July as he faced rising bills from tariffs on European partners.
I would buy all my steel from domestic mills if I had the option. The reality is that the capacity isn't in place to meet it.
Today, Berggren has cargo from Turkey on its way to Houston. He says his Turkish supplier is in an array of panic at the moment. Neither side sure what that steel will cost when it gets there or what this escalation means for future business. For Nightly Business Report, I'm Kayla Tausche in Washington.
As we mentioned, the drama in Turkey rattled investors here in the U.S. today, adding to those jitters inflation. Consumer prices rose slightly last month, but the 12-month core reading rose nearly 2.5%. That was the most we've seen in nearly a decade. Stocks did come off their lows, but it was still a Friday solidly in the red. The Dow was down 196 points when the bell rang at 25,313. The Nasdaq fell by 52, snapping its 8-day win streak, and the S&P was off by 20. For the week, The NASDAQ was the only positive index. Seema Modi has more on today's action.
Financial fears swirling around Turkey shook up global markets today after the Turkish lira plummeted 20% to a record low against the U.S. dollar. Financials lagged on the session. Banking stocks like Goldman Sachs and J.P. Morgan took a hit on fears that Turkey's financial crisis could spill over into the global banking space. Bond yields also tumbled to session lows as investors poured money into treasuries in a flight to safety play. And gold prices got a bid, but ended lower on the week. The big question on the trading floor is what international risks mean for Fed policy. Today's latest read on inflation looks like it would put the Fed on course to continue raising rates, but that would push the dollar even higher against the Turkish lira, further exacerbating Turkey's financial woes. President Donald Trump added fuel to the fire, announcing he would double Turkey's metals tariffs as the lira remains in a free fall. Industrial stocks took a hit on that news. Remember, manufacturing giants like Boeing and Caterpillar are often seen as classic proxies for trade war concerns. For Nightly Business Report, I'm Seema Modi at the New York Stock Exchange.
Let's turn now to Art Hogan for more on Turkey and why we should care about what's happening in that part of the world. He is Chief Market Strategist at FB Riley FBR. Good to see you again, Art. Welcome back.
Thanks, Sue. Great to see you.
It's good to see you as well. Let's talk about strategically how important Turkey is. And there are those who think that this may be the beginning of more of a global trade war, including China and maybe Russia.
Yeah, unfortunately, the global trade war, or the trade tension that we're having right now doesn't seem to be going away anytime soon, and this doesn't help that. So to put this in perspective, first and foremost, it's a Friday in the summertime, so the market's reaction to any news on the macro is going to be larger. We've ended the reaction to the micro, which is earnings, and we've put a lot of the macro concerns behind us, but you could feel that switch over today. You get some news out of Turkey, it escalates, and the market pays attention to it in a low volume Friday. I think the second thing, in terms of trade, it feels like there are spots that are getting better, like North America, Mexico, and Canada, and the Eurozone in particular, where we haven't escalated things. But China, for sure, has not seen any de-escalation. I think that's the biggest headwind for the market right now, is trade tensions and how bad they can get.
And the strengthening dollar. You know, we talk so much about how they're trying to improve things for multinationals here in this country when it comes to trade. But it doesn't help when the dollar continues to strengthen, right?
No, it sure doesn't, Bill, and clearly that goes hand in glove. Both our monetary policy and our trade policy clearly strengthening the U.S. dollar, and that adversely affects emerging markets, and clearly Turkey is the poster child for who gets hurt with a stronger dollar, but all emerging markets do, and unfortunately that's the offshoot of this. So until we get to some point where there's an exit ramp on the trade war highway and start to get to negotiations and see an easing in that strength of the dollar, we're going to see more situations where that strong dollar is adversely affecting emerging market countries, and Turkey just seems to be the one that's in the hot spot right now.
The European banks, which some have quite a bit of exposure to Turkey, when will we know whether or not they are going to be hurt by this situation here?
Yeah, I think you're going to know pretty quick, and I would offer up that we'll probably hear from the three largest of those banks, and they're in Italy, they're in Spain, and they're in France, and you know, so clearly those are the three large banks that have the most exposure, and we'll probably get a statement out of them in terms of where they stand right now, what their overall exposure is, because their equities are starting to get hit. You know, we know exactly where the players lie, and I think that that's going to be next week's business, where they say, here's our net exposure, and that probably doesn't help them.
Quickly, Art, before we let you go, you know, the Fed's made it clear that they would like to raise rates at least 2 more times before the end of this year. Do you think they might be rethinking that, given what's going on right now?
That's such a great question. You know, the Fed so far and Jay Powell have certainly been ignoring a lot of the global events and clearly ignoring a flattening yield curve and plodding along, leaning against a strong economy, trying to normalize rates. I'm not sure that this is going to be enough to get them to blink and perhaps only go one more time this year, but that's a question that we heard all day long.
Art Hogan, as always, thank you. Art is with B. Riley FBR. Bill?
Oil prices, by the way, continue their slide, posting a 6th straight weekly decline. That market's worst streak in 3 years, by the way. Today, domestic crude was able to rise 1% to settle above $67 a barrel. But the fear is that trade disputes could slow growth and therefore dampen demand for oil. But as Jackie DeAngelis tells us now, there is a lot more that people are watching in the oil patch.
With the national average for a gallon of regular gasoline at $2.87, just under that $3 mark, oil prices continue to be on everyone's minds: global producers, consumers, and the president. The International Energy Agency issued its monthly report today, saying the markets are calm, but that could change. Iran is in focus now, as a second round of sanctions will be put in place in November. That could remove as much as 1 million barrels a day of supply offline, maybe even more. If that were to happen, prices would go up, but it's unclear how U.S. allies and purchasers of Iran's oil will respond to the sanctions. That's why analysts believe Saudi Arabia has been cautious about adding barrels back online. Today, the IEA said OPEC's output was flat in July, even when the cartel said in June it would add supply to make up for Iran. What we know right now is the glut that the market was worried about has slowly worked itself out. Supply and demand are more balanced, but in a tight market, prices can move quickly. So a more clear picture should emerge in about 3 months' time. But for now, prices could dip as the summer driving season comes to a close. For Nightly Business Report, I'm Jackie DeAngelis.
It is time to take a look at some of today's upgrades and downgrades. Intel getting its second big downgrade of the week. This time, Goldman Sachs taking it from neutral to sell. The firm cites manufacturing issues, which it says could hamper Intel's ability to sustain margins and grow earnings. The price target was cut from $53 to $44 a share. Today, shares closed at $48.85, down 2.5%. Oppenheimer thinks the trade fight with China could hit Tiffany, and the firm is downgrading the jeweler from outperform to perform. The analyst still likes Tiffany's long-term prospects, but is concerned about short-term currency fluctuations, particularly a devaluation of the yuan, which could impact the buying power of Chinese tourists here in the U.S. The price target was kept at $145. Tiffany finished at $134.34, down 2% today.
J.P. Morgan is downgrading shares of Campbell Soup from neutral to underweight. The analyst there sees a potential sale of the company as an unlikely outcome. You may remember last week a report surfaced saying that Kraft Heinz had started exploratory talks about buying Campbell Soup. Price target there now 36. Campbell closed at 41.35, off more than 2% today. And SunTrust is initiating coverage of online personal shopping service Stitch Fix. It's got a buy rating now. The firm says that Stitch Fix is the leading pure play in the sector and should continue to outperform expectations. Price target set at $38. In a down day, shares finished at $33.31, up about 5%.
Tesla is reportedly looking for a wide pool of investors to back CEO Elon Musk's plan to take that automaker private. Bloomberg says the move would help Tesla avoid concentrating ownership among a few large stakeholders.
Well, Elon Musk has become certainly a celebrity CEO who is closely tied to his company Tesla, just like the late Steve Jobs was to Apple, the beloved Jack Welch to GE. But is it a good thing for investors when the CEO becomes the brand? J.J. Kinahan is chief strategist at TD Ameritrade. He joins us now.
Hey, Bill.
Talk with us. Hey, J.J., welcome. I know you keep a close tab on what your customers buy on, month to month and so forth, and often Tesla comes up as one of their top holdings. It's called betting the jockey, when you want to buy the CEO or the face of the company rather than just the company itself. Is that a good idea or not, do you think?
Well, I don't think it's a bad idea. You talk about Steve Jobs right there, and obviously he as a CEO became sort of the brand to people at some point. You may start with the CEO attracting you to the product, but then the product itself, as long as it's a good product and people start to become loyal to it, it becomes a very nice circle if you're that company. You like the CEO, you like the product, and you keep being drawn one to the other. So there's nothing wrong with doing that. And you, of course, like with any investment, you don't want to do it blindly. But if you have a good product, a good CEO who seems to be running things in a very good manner, there is nothing wrong with that. The problem becomes when the CEO sort of goes off the ranch,
Right.
if you will. Mm-hmm. That's when things can get a little bit hairy for investors.
We purposely pointed out companies outside of the tech arena, like a GE. Right. Bill was mentioning earlier when we were talking, Martha Stewart, her brand, she was so closely associated with it. But is the betting the CEO a phenomenon that is more common in technology because of the innovation side of things?
I think, too, absolutely it is, because, you know, using Mr. Musk as an example, he clearly thinks differently than other people do. He sees opportunity where others may not see it, and it's amazing. You know, you read his biography, you read things that he looks at in terms of solar, in terms of space travel, et cetera. He just sees things that others don't. So that's amazing, and I think people want to bet on the opportunity that he sees because they see opportunity with it. You know, but one of the things that we have seen in the tech space, again, probably more than anywhere else, is because there's so many entrepreneurs. Being a great entrepreneur does not necessarily always mean you're a great CEO.
Back to Jack Welch before we let you go. There was clearly a Welch premium in General Electric stock when he retired. And over the last 15 or 18 years or so, it has definitely come out at that point. So there is something of a danger there, isn't there?
Absolutely. When you are having a CEO so closely associated with the brand, and I will go back to the Apple example for a second. Tim Cook had to not only prove he was a CEO, he had to step in and take the place of a beloved CEO. So the test track for you is much higher, and you have to beat a higher standard in order to take the company stock price higher. And once you start doing that, all of a sudden you can become a beloved CEO also.
J.J. Canahan with TD Ameritrade. Always good to see you. Thanks.
Great to be here. Thanks, guys.
Coming up, why the housing market might be in for a rough second half of the year.
There may be cracks forming in the housing market. Two new reads on the industry are not painting a rosy picture for the remainder of this year. Diana Olick explains why.
There are more of these out today than there were a year ago, but home buyers are still pulling back. Last year, the problem was no supply. Now, the problem is price. Affordability fell to the weakest level in a decade this past spring, according to the National Association of Home Builders. That was thanks to higher home prices and higher mortgage rates. Just 57% of the homes sold were affordable to Americans making the median income. That's down from nearly 62% in the first 3 months of this year. While that is a national picture, in some markets the situation is worse. Most of the least affordable markets are in pricey California, but in Boston, Seattle, Miami, Portland, Oregon, and Reno, less than 40% of the residents making the median income can afford the median-priced home.
Where I want to buy, in the neighborhood I want to be in, I just can't afford, so it's better for me to rent.
You can enter a lottery but that's the only way I could see myself buying within the city.
Affordability is likely behind a drop in housing sentiment among consumers. A new report from Fannie Mae showed fewer Americans think now is a good time to either buy or sell a home. Fewer also said they felt sure about keeping their jobs in the coming year. For the largest generation, millennials, that means waiting.
What they're telling us is, but we have to have a good job. That job has to have a growing income. We have to have our credit in shape, and we're probably going to get married and have a baby before we're in a position to buy that house.
None of this bodes well for home sales in the second half of this year, especially if mortgage rates move any higher, which they could potentially do, weakening affordability even further. For Nightly Business Report, I'm Diana Olick in Washington.
General Electric will reportedly sell its power conversion business for much less than what it paid for it. That's where we begin tonight's Market Focus. Bloomberg says GE is working with Credit Suisse bankers to sell the unit for $1.5 billion. GE bought the division back in 2011 for more than $3 billion. The sale process could begin as soon as next month. Shares of GE fell 1% to finish at $12.77. Alnylam said the FDA has approved its first drug, which is intended to treat a rare and often fatal hereditary disease. It's also the first approved treatment in a new class of drugs that use what's called gene silencing technology. The method targets a specific area to keep genes from producing a harmful protein. Shares of Alnylam rose 3% to finish the session at $97.38.
Nike is being sued by a group of former female employees who allege that the athletic apparel maker fostered a hostile work environment and discriminated against women. The suit says that Nike was unfair when it came to pay, promotions, and conditions of employment. It also alleges the company tolerated and at times ignored sexual assault. Nike shares were off a fraction today to 80.73. And VF Corp is reportedly considering selling or spinning off its denim business, which includes the Wrangler and Lee brands. The Wall Street Journal says that VF faces weak demand for its jeans amid increased competition. Shares rose a fraction to $96.29 today.
Time now for our weekly market monitor, who has names of stocks he says you may want to own in an uncertain environment. The last time he was on in August of 2017, he picked Valero, which is up 71%, Accenture, which is up 25%, and Digital Realty, which is 3% higher. He is Bob Phillips. He is the managing principal at Spectrum Management Group. Good to have you back. Welcome back.
Thank you, Sue.
Let's start with our picks today. And this is a master limited partnership fund. The symbol is AMLPX, and it's Main Gate. Why do you like it?
I like it. I think the energy pipeline companies have been misunderstood for the last couple of years. So at its essence, they're trading at about 7.5 times cash flow, and that cash flow is growing 8 to 13% a year. So you can get a 7.5% dividend right now. You got great underlying growth, and that dividend should be growing along with price appreciation over the next several years.
Avery Dennison, boy, I think Avery and the office supplies, and now Avery Dennison, they've gone high tech with these smart labels they have out there. How do you see that as a defensive play in an uncertain environment?
Well, Bill, it gets back to they've got great positioning in emerging markets for one. So their product makes global supply chain management and inventory management so much more efficient that that segment is growing by 20% a year. And I think that it can do that for quite some time. I think they are immune from trade wars and tariffs because they produce around the world. And I think they've just got a nice long growth trend ahead of them. They're paying about a 2% dividend. We think they'll keep growing that dividend by about 10% a year.
And we finish up with JP Morgan Chase, a large, stable blue chip.
Yes, large, stable blue chip. Last quarter, the bank grew their revenue by 9% from investment banking, from their trading services and asset management, as well as just core loan growth. So about 80% of their business is in the U.S. We think they've got a great chance to keep expanding internationally as other international banks, predominantly European banks, have to pull back. And management just announced they're going to raise the dividend 40% in the third quarter of this year, and we believe they'll keep doing that. I think Bloomberg's projecting they'll grow the dividend 20% per year for at least the next 3 years. So if you buy it today, you got a 2.7% dividend. If you hold it for 3 years, you probably will be getting about 5% on your investment.
All right. We'll keep track of it. Thanks, Bob. Appreciate it. Bob Phillips with Spectrum Management Group. And to read more about Bob's picks, head to our website, nbr.com.
Coming up, how sports teams are leveraging their brands to bring in more fans.
And finally tonight, a number of sports teams are expanding into entertainment businesses in the hopes of creating a new revenue stream. They're adding their brands to almost everything from hotels to amusement parks. Eric Chemi has the details.
It used to be take me out to the ball game, take me out with the crowd, but not anymore. Today, professional sports teams are now looking off the field for their next big way of making money. The Texas Rangers this weekend opening a brand new entertainment complex outside their stadium. It's called Texas Live and features dining, bars, music, and entertainment venues. Soon to come is a Lowe's hotel. The Rangers are just the latest team to use land next to their stadium for bigger entertainment goals, joining recent development projects in Sacramento, St. Louis, and Philadelphia. Part of the trend shift is the fact that the teams are taking ownership stakes in these development projects.
There's only so many dollars that you can generate from ticket sales and TV revenue, so this is just an added revenue source.
It comes down to one thing: making money. With media rights fees and ticket sales seeing a lot more challenging environments recently, teams are trying anything they can to take advantage of the value of their brands, to bring in fans even when it's not a game day.
What you see today opening is mammoth. It's a couple $2 billion of investment, but it's just the tip of the iceberg, and it will become where people will come for the weekend. So maybe now you used to drive to a Ranger game, go back home. Now you come for the weekend because of all the things you can do. The hotel connected to the ballpark, you stay in. It's going to be a win-win-win.
Baseball teams have about 80 home games a year. Football teams only have 8. That leaves the vast majority of the calendar open as an opportunity to make more money on the same land. In many ways, modern sports ownership groups see their teams and stadiums as just one part of a broader portfolio featuring real estate, media, and entertainment. For its 1, 2, 3 entertainment options at the new ballgame. For Nightly Business Reports, I'm Eric Chummy.
Before we go, one last look at the day on Wall Street. The Turkish financial crisis took a toll on the European markets this morning and ours as well. The Dow down 196 points. The NASDAQ dropped by 52, snapping its 8-day win streak, by the way, and the S&P was off by 20. For the week, the NASDAQ was the lone gainer. That is Nightly Business Report for tonight for a Friday.
Yep.
I'm Bill Griffith. Thanks for watching.
Have a great weekend. I'm Sue Herrera. Thanks for joining us. See you on Monday.